Friends, thank you for being here today. What if I told you that your country is on sale and you're the only one who doesn't know the price tag? What if the invisible force that's been quietly draining your purchasing power isn't inflation alone, but something far more deliberate, a systematic transfer of wealth happening in real time, disguised as currency fluctuation? Let me give you a number that should stop you in your tracks. 69 cents. That's where the Canadian dollar sits today against the US greenback. Now, you might think that's just a market correction, a temporary dip in the exchange rate that will eventually balance itself out. But what I'm about to show you is that this isn't a correction at all. It's a liquidation event. While Canadian families struggle with grocery bills and mortgage payments, American private equity firms are walking across the border with their strong US dollars and buying Canadian infrastructure, Canadian technology, Canadian resources at a 30% currency discount. This is not a market fluctuation. This is a clearance sale on an entire nation. Let me put this in perspective with a metric that should make your blood run cold. $7 billion. That's the amount Blackstone, one of the world's largest private equity firms, invested in Rogers Communications infrastructure in mid-2025. They didn't just buy a company, they bought a piece of Canada's digital backbone. Your internet, your wireless network, your communication infrastructure, now owned by American capital, purchased at a discount created by your own weak currency. But here's where it gets worse. In the first 9 months of 2025 alone, 54% of all capital invested in Canadian companies came from US investors. Think about what that means. The majority of new funding for Canadian business, the lifeblood of innovation, the engine of your future economy, is now American. You're not building your own future anymore. You're selling it piece by piece at bargain basement prices. This is a structural fault line. This is a mathematical endgame, and the most terrifying part, the system is designed to ensure you cannot escape it. Let me explain why this is happening through a mechanism the financial press doesn't want you to understand. They'll tell you that interest rates are a tool for managing inflation. They'll tell you that currency fluctuations are natural market forces. But what they won't tell you is that your central bank has been forced into an impossible choice, a choice that guarantees the liquidation of Canadian sovereignty. Here's the trap. The Federal Reserve in the United States has cut rates to approximately 3.75 to 4%. Meanwhile, the Bank of Canada has been forced to cut much deeper, down to 2.25%. Why? Because Canada's housing market, built on a foundation of variable rate mortgages and unprecedented household debt, would collapse entirely if rates remained high. Canadian families are so over-leveraged that even a modest rate increase would trigger a cascade of defaults, foreclosures, and financial ruin. So the Bank of Canada cut rates to save the mortgage holder. But in doing so, they sacrifice something far more valuable. They sacrifice the currency itself. This 150 plus basis point gap between US and Canadian interest rates acts like a gravitational force, pulling investment capital out of Canada and into the United States. Think of it as a one-way valve. Money flows south, chasing higher returns in US assets, while Canadian assets become cheaper and cheaper for foreign buyers. The Bank of Canada chose to save your mortgage by selling out your currency. They chose to protect your house by putting your entire country on the auction block. Now, some of you might be thinking, but a weak dollar is good for exports, right? Doesn't it make Canadian products more competitive internationally? That's the myth they want you to believe. That's the outdated economic textbook theory from an era when Canada still manufactured goods at scale. But here's the reality in 2025. Canada doesn't manufacture enough anymore for that to matter. What does matter is this. When your currency is weak, imports become expensive. Food, electronics, machinery, pharmaceuticals, All the things Canadians need to survive and compete become more costly. A weak dollar doesn't boost your economy through exports. It bleeds your economy through imported inflation while simultaneously making your assets attractive targets for foreign acquisition. You're not exporting your way to prosperity. You're importing inflation while exporting ownership of your future. Let me take you back to understand how we arrived at this moment. This didn't happen overnight. This is the final act of a long tragedy. And to understand where we're going, you need to understand where we've been. Cast your mind back to 2011 to 2014. Those were the glory days of what I call the petrodollar peak. The Canadian dollar was at parity with the US dollar. One Canadian dollar bought you one US dollar. Canadians were buying Florida condos for cheap. Canadian retirees were snowbirds with purchasing power. Canadian companies could compete for talent and resources on equal footing with their American counterparts. The country felt rich because, in global terms, it was. What sustained that strength? Oil. Specifically, oil prices above $100 per barrel. Canada, as a major petroleum producer, rode the commodity supercycle to currency strength. The loonie was a petrocurrency, and as long as energy prices remained elevated, Canadian wealth, measured in global purchasing power, remained intact. But that era is over. Oil prices normalized, the commodity boom ended, and the structural weaknesses in the Canadian economy, the household debt, the over-reliance on real estate, the erosion of manufacturing became impossible to ignore. The currency began its descent from parity in 2014 to 69 cents in 2025. That's not a market fluctuation. That's a 30% devaluation of every dollar in every Canadian bank account, measured against global purchasing power. Here's what that means in practical terms. You didn't lose money in your bank account. The number didn't change, but your money lost its power to leave the country. You became 30% poorer relative to the rest of the world, and you probably didn't even notice it happening because your domestic prices adjusted slowly, like a frog being boiled alive. Now, let me explain the mechanism through which American capital is exploiting this weakness. I call it the discount loop. And once you see it, you'll understand why the liquidation is not just happening, it's accelerating. Imagine two neighbors living side by side. One prints strong dollars, that's the United States. The other prints weak coupons, that's Canada. Now the American neighbor comes over with his strong dollars and offers to buy your house. He offers you 100 coupons, which sounds fair because that's the market price in coupons. You accept because, from your perspective, you got a fair deal. But here's the trick. To him, paying 100 of your coupons only cost him 70 of his dollars because of the exchange rate. From his perspective, he just bought your house at a 30% discount. You thought you got market value. He knows he got a steal, and now he owns your house. This is not a metaphor. This is exactly how private equity operates. Firms like Blackstone and BlackRock don't see the weak Canadian dollar as a problem. They see it as an opportunity. They use their strong US dollars to acquire Canadian assets, assets that are perfectly healthy, perfectly functional, perfectly valuable, but priced in a dying currency. To them, Canada is a distressed market. To you, you're just living your life, but slowly, methodically, they're buying the whole block. And here's the secret that ties this all together. The mechanism that ensures this liquidation will continue. The Bank of Canada cannot stop it. They are trapped. If they raise interest rates to defend the currency, the housing market collapses. Variable rate mortgages, which millions of Canadians depend on, would reset at unsustainable levels. Defaults would cascade, home prices would crater, the financial system would seize up, the political cost would be catastrophic. If they cut rates further to stimulate growth, the currency weakens even more. The discount for American buyers gets deeper. The fire sale intensifies. Import inflation accelerates. The cost of living spikes even faster. This is what I call the 69-cent trap. The Bank of Canada is checkmated. Every move they make accelerates the liquidation. And American private equity firms know this. They can see the trap as clearly as I can, which means they know the sale isn't temporary. The sale is permanent, and that knowledge is driving them to move aggressively, to deploy their dry powder, the billions in capital they have ready to spend before the rest of the world catches on. This leads us to the system's most crucial secret, which we will explore next. Why this isn't just about currency anymore. It's about sovereignty itself. Now that you understand the trap, let me show you the trigger, the specific moment when this slow motion liquidation shifted into overdrive. December 2025, the Bank of Canada held its policy rate at 2.25%, while the Federal Reserve, after a year of aggressive rhetoric about fighting inflation, cut less aggressively than the market had hoped. This wasn't just another central bank meeting. This was the moment the divergence became permanent. This was the moment global investors realized that Canada cannot raise rates without destroying its own economy, while the United States can maintain higher rates indefinitely because its economy, and more importantly, its currency, is the global reserve standard. What does that signal to sophisticated investors? It tells them the yield gap is structural, not temporary. It tells them the Canadian dollar is effectively capped. It cannot rise. The ceiling is baked in by household debt, by political constraints, by the mathematical reality of an over-leveraged economy. And if the loonie cannot rise, then the discount is permanent. In the language of private equity, that signal translates to one simple message: come and buy. The sale isn't ending. Stock up, and they are. Let me show you the evidence. Let me show you the canaries dying in the coal mine while the press tells you everything is fine. Canary number one, the tech exodus. Canada has long prided itself on its innovation sector. The AI researchers in Montreal and Toronto, the tech startups in Vancouver and Waterloo, these were supposed to be the seeds of a new economy, a way to transition from resource extraction to knowledge creation. But here's what's actually happening. Canadian tech startups are being bought by US private equity firms at record rates. That 54% figure I mentioned earlier, that's not just capital flowing in for expansion, that's ownership changing hands. When a Canadian AI startup takes US funding, it doesn't stay Canadian for long. The IP migrates south. The talent follows the capital. The headquarters relocate to Silicon Valley or Austin or Boston. You're not building your future innovation economy. You're incubating it for American acquirers. You're training the workforce, subsidizing the research through your universities, taking the early stage risk, and then watching as the value is extracted the moment it matures. This is what liquidation looks like in the knowledge economy. You're selling your future to pay for today's debts. Canary number two, the pure play exit. Look at what's happening in the resource sector. Companies like Baytex Energy, Canadian oil producers with operations on both sides of the border, are making a calculated decision. They're exiting Canadian operations to become pure play US producers, or they're being acquired outright by American firms. Why? Because the capital markets are telling them that Canadian assets trade at a discount. An oil barrel produced in Alberta is worth less to investors than an identical barrel produced in Texas, not because of the quality of the resource, but because of the currency it's denominated in and the regulatory environment it's extracted from. The capital is fleeing to safety. Your resource wealth isn't disappearing from the ground, it's disappearing from Canadian ownership. The oil, the gold, the uranium, it's all still there. But increasingly, the profits flow south because the ownership has migrated. You're becoming a branch plant economy again, except this time you don't even own the plants. Canary number 3, the vacation indicator. Here's one that should sting on a personal level. U.S. tourism to Canada is booming, and the headlines celebrate it as economic good news. More American visitors means more spending, more jobs in hospitality, more economic activity, right? But look closer at why they're coming. Canada isn't attracting tourists because it's become more desirable as a destination. It's attracting tourists because it's become cheap. Canada is now a discount destination. Americans are flooding into Vancouver, Toronto, and Montreal for the same reason they flood into Mexico or Southeast Asia, because their currency goes further. You're not an economic peer anymore. You're a bargain. And while the tourist revenue might provide a short-term sugar high for hotels and restaurants, the underlying reality is devastating. Your country is being repriced as a second-tier market. The exchange rate isn't reflecting temporary weakness. It's reflecting a permanent downgrade in how the world values Canadian economic sovereignty. Now, let me show you why this cannot be fixed through conventional policy. Let me show you why the trap is inescapable. The Bank of Canada faces what game theorists would call a trilemma, a situation where you must choose between 3 objectives, but you can only achieve 2 at most. In Canada's case, the 3 objectives are stable currency, stable housing market, and independent monetary policy. You cannot have all 3 simultaneously. If Canada raises rates to defend the currency and assert monetary independence, the housing market implodes. I'm not being hyperbolic here. The average Canadian household debt-to-income ratio is among the highest in the developed world. Variable rate mortgages, products that adjust with policy rates, represent a significant portion of outstanding mortgage debt. When rates rise, monthly payments explode. Families that were managing their debt at 2.25% cannot manage it at 4% or 5%. Defaults cascade. Housing prices collapse as distressed sellers flood the market. Bank balance sheets take massive losses on mortgage portfolios. The entire financial system seizes up. The political cost of this scenario is unthinkable. No government can survive a housing crash that destroys the wealth of the middle class. So this option, while theoretically available, is politically impossible. If Canada cuts rates further to stimulate growth and support the housing market, they maintain domestic stability, but at the cost of the currency. Every rate cut widens the yield gap with the United States. Every widening of the gap accelerates capital flight. Every dollar that leaves Canada chasing higher U.S. yields weakens the loonie further. And every increment of weakness makes Canadian assets cheaper for foreign buyers. The discount deepens. The liquidation accelerates, import inflation spikes because everything Canada doesn't produce domestically, which is most things, becomes more expensive. This creates a perverse feedback loop. Cut rates to save the housing market, weaken the currency, drive up the cost of living, force workers to demand higher wages, push companies to raise prices, generate more inflation, which would normally demand higher rates, but you can't raise rates because of the housing market. You're trapped in a doom loop. The third option, maintain current policy and hope for the best, is simply slow motion capitulation. It's choosing to accept the liquidation as the price of short-term stability. It's deciding that foreign ownership of Canadian assets is preferable to domestic financial collapse. It's a surrender dressed up as pragmatism, and the Americans know all of this. The sophisticated players, the Blackstones, the BlackRocks, the pension funds, the sovereign wealth managers, they can read a balance sheet, they can see the debt levels, they can see the political constraints, they know the Bank of Canada is checkmated, and they are positioning accordingly Let me give you a specific example of how this plays out in practice. In mid 2025, Blackstone deployed $7 billion into Rogers Communications infrastructure. Now, on the surface, this looks like foreign investment capital flowing into Canada, creating jobs, building infrastructure. The politicians probably celebrated it, but let's look at what really happened. Blackstone didn't buy Rogers because they believe in the long term growth potential of the Canadian telecommunications market. They bought it because the weak Canadian dollar made the acquisition cheaper in US dollar terms. They bought it because Canadian pension funds and institutional investors, facing their own liquidity constraints and pressure to show returns, were willing sellers. And most importantly, they bought it because infrastructure assets generate cash flow in Canadian dollars that can be extracted and converted back to US dollars at a profit, especially if the loonie weakens further. This is the genius of the strategy. They're not betting on Canada's success. They're betting on Canada's continued weakness. The weaker the loonie gets, the more profitable their investment becomes when they repatriate earnings. They've essentially shorted Canadian sovereignty while simultaneously owning a piece of its critical infrastructure. It's a perfect hedge. If Canada somehow stabilizes and the currency recovers, they own valuable assets. If Canada continues to deteriorate, they're extracting value from a depreciating currency base. And here's the kicker: the more foreign ownership increases, the more vulnerable Canada becomes, because now you have a significant portion of your critical infrastructure, your telecommunications, your energy distribution, your food processing, your technology platforms owned by foreign entities whose primary obligation is to their shareholders, not to Canadian citizens. When decisions about investment, pricing, and strategic direction are made in boardrooms in New York or Houston or Zurich, Canadian interests become secondary considerations at best. This is what I mean when I talk about financial colonization. You're not being annexed politically. There's no invasion, no treaty, no formal surrender of sovereignty, but you're being annexed financially. If your internet is owned by American capital, if your apartment building is owned by American capital, if your employer is owned by American capital, if your grocery store is owned by American capital, does the border even matter anymore? You're living in a branch plant economy where the profits flow south and the decisions are made elsewhere. The liquidity tide is going out, and we are about to find out who has been swimming naked. We are facing a convergence, not a series of isolated problems that might resolve independently, but three distinct forces hitting simultaneously, each amplifying the others, creating a vortex that pulls Canada deeper into economic subordination. Force number one, the housing debt bubble. This is the anchor around Canada's neck, the reason the Bank of Canada cannot pursue any monetary policy that prioritizes currency strength or economic sovereignty. Canadian household debt relative to disposable income sits at levels that would terrify any rational observer. Families have borrowed against inflated home values to finance consumption. They've taken variable rate mortgages, betting that rates would stay low forever. They've turned their primary residences into ATMs, extracting equity to fund lifestyles that their wages alone cannot support. This isn't wealth. This is leveraged speculation masquerading as middle class stability. And it has created a hostage situation where the entire monetary policy framework must prioritize debt service over every other consideration. Force number two, US dollar strength. This isn't about America doing something to Canada. This is about the structural reality of the global monetary system. The US dollar is the world's reserve currency. When global uncertainty rises, capital flows to dollars. When the Federal Reserve maintains higher rates than other central banks, capital flows to dollars. When investors need liquidity, they sell everything else and buy dollars. This creates a gravitational pull that no mid-sized economy can resist. The stronger the dollar gets, the weaker everything else becomes by definition. And in a world where the dollar is strong, commodity currencies like the loonie get crushed. Canada isn't just competing with US monetary policy, it's competing with the entire architecture of global finance. And that is a fight it cannot win. Force number 3, private equity aggression. The titans of American finance, Blackstone, BlackRock, Apollo, KKR, are sitting on unprecedented amounts of what they call dry powder. These are committed funds from investors that must be deployed. These firms are legally obligated to find returns for their limited partners. And right now, Canada represents one of the most attractive hunting grounds in the developed world. It's a stable democracy with rule of law, so there's minimal political risk. It has valuable assets in resources, technology, and infrastructure. And most importantly, everything is on sale at a 30% discount because of the currency. These firms aren't being predatory in the traditional sense. They're simply being rational. They see an opportunity and they're taking it. But the result, regardless of intent, is a massive transfer of Canadian wealth and ownership to foreign hands. These three forces are not separate. They feed each other. The housing debt prevents rate hikes, which weakens the currency, which attracts private equity, which increases foreign ownership, which extracts more capital, which weakens the economy, which makes it harder to service the housing debt. It's a self-reinforcing cycle of decline. Now, let me talk about the psychological trap that prevents most Canadians from recognizing what's happening. Let me talk about normalcy bias. Human beings are hardwired to believe tomorrow will look like yesterday. We assume that the patterns we've experienced throughout our lives will continue indefinitely. If you've lived your entire life in a country where the currency was relatively stable, where home prices generally went up, where the standard of living gradually improved, your brain defaults to assuming that's the natural order of things. When warning signs appear, you rationalize them away. The dollar is just going through a rough patch. Real estate always recovers. This is just a temporary adjustment. This cognitive bias is what allows catastrophic change to happen in plain sight. The collapse doesn't feel like a collapse when you're living through it day by day. It feels like a series of minor inconveniences, small disappointments, marginal adjustments. Your groceries cost a bit more. Your vacation to the US is more expensive. The Canadian company you worked for gets acquired by an American firm. Each individual event seems manageable, unremarkable even. But zoom out and you're watching systematic dismantlement of economic sovereignty. Here's the other psychological trap: the money illusion. Your bank account says you have $100,000. That number hasn't changed. So you feel like your wealth hasn't changed. But if the purchasing power of those dollars has declined by 30% internationally, you become 30% poorer without the number moving at all. You become a millionaire on paper, but poorer at the grocery store. You become richer in nominal terms while becoming poorer in real terms. And because the decline happens gradually, because the number in your account stays the same or even grows with modest interest, you don't feel the theft happening. But it is happening. Every day the loonie trades at 69 cents instead of parity. You're being taxed by currency debasement. So what do? What does the rational individual do when faced with this convergence of forces? Let me frame this as a binary choice, a choice between participating in the illusion or stepping into reality. The question you need to ask yourself is this: do you own assets or do you own claims on assets? If you own Canadian stocks, you own claims. You own paper that says you have a share of a company's future profits, denominated in Canadian dollars. If that company is bought by foreign capital, you might get a buyout premium, but you're converting your claim into someone else's ownership structure. If the Canadian dollar continues to weaken, the international value of those profits declines. You're holding paper wealth that's denominated in a depreciating currency. If you own Canadian bonds, you own claims. You own a promise that the government or a corporation will pay you back in Canadian dollars plus interest. But if those dollars are worth less when you get them back than when you lent them out, you haven't earned a return. You've taken a loss disguised as a profit. If you hold cash in Canadian dollars, you own the purest form of the claim. You own the government's promise that this paper has value, but that value is being systematically destroyed by the yield gap, by the currency debasement, by the structural forces we've discussed. So, what's the alternative? What does it mean to own assets rather than claims? It means owning things that have value independent of which government prints the paper. It means owning gold and silver, physical metal that has been recognized as wealth for thousands of years across every culture and every monetary system. Gold doesn't care if the loonie is at 69 cents or at parity. Gold doesn't care if the Bank of Canada cuts rates or raises them. Gold is simply gold. It's dense, it's rare, it's durable, it's divisible, and it's universally recognized. When currencies fail, and they do fail regularly throughout history, gold remains. This isn't investment advice. I'm not telling you gold will go up in Canadian dollar terms, though it probably will. What I'm telling you is that gold allows you to step out of the line of fire. It allows you to store wealth in something that isn't being actively devalued by central bank policy. It allows you to hold purchasing power in a form that doesn't depend on the solvency of over-leveraged governments or the stability of overextended banking systems. Some of you will say, but gold doesn't pay interest. It doesn't generate cash flow. It just sits there. And you're right. Gold is not an investment. It's insurance. It's a position outside the system. And in a world where the system is designed to extract value from currency holders to protect debt holders, being outside the system is exactly where you want to be. The alternative is to do what the smart money is already doing. Hold US dollar assets. If the trend is for Canadian wealth to flow south, position yourself on the receiving end of that flow rather than the sending end. Hold US stocks, US bonds, US real estate if you can access it. At least then you're holding the currency that's doing the buying rather than the currency being sold. But understand what you're doing if you make that choice. You're essentially accepting the premise of financial colonization and trying to profit from it. You're acknowledging that Canada is being liquidated and positioning yourself with the liquidators rather than the liquidated. There's nothing morally wrong with that. It's rational self-preservation. But it does mean accepting that the country as you knew it is finished as an independent economic entity. Here's what I want you to understand as we close. This is not a conspiracy. This is not a hidden plot by shadowy elites. This is stated policy playing out to its logical conclusion. The Bank of Canada has openly chosen to prioritize housing market stability over currency strength. The Federal Reserve has openly pursued a strong dollar policy. Private equity firms openly disclose their investment strategies in regulatory filings. Everything I've described is happening in plain sight. The information is public. The mechanisms are documented. The only secret is that most people aren't paying attention, and those who are don't want to believe what they're seeing. But mathematics doesn't care about belief. The yield gap is real. The currency discount is real. The transfer of ownership is real, and it's accelerating. Every month that passes, more Canadian assets fall into foreign hands. Every quarter, more of the profits generated on Canadian soil flow to foreign shareholders. Every year, the economic sovereignty of the nation diminishes. You cannot stop this at the individual level. You cannot vote your way out of structural economic forces. You cannot petition the government to solve a problem that the government's own policy choices created. What you can do is protect yourself. You can recognize the reality of the situation and position your own wealth accordingly. You can refuse to be the frog in the pot, accepting gradual boiling because each individual degree of temperature increase seems tolerable. The window for preparation is closing, not because some arbitrary deadline is approaching, but because the forces in motion are accelerating. The longer you wait, the fewer options you have, and the more expensive those options become. If you wait until the crisis is obvious to everyone, you'll be making decisions in a panic alongside millions of other people who also waited too long. And in a panic, you don't get good prices. You get whatever is available, if anything is available at all. History favors the prepared. History punishes those who mistake the temporary stability of the present for the permanent order of the future. And right now, in late 2025, the stability you're experiencing is temporary. The liquidation is permanent. The 69-cent loonie isn't an accident of markets. It's a price tag on an entire country, and the sale is already underway. The only question that remains is this: will you recognize what's happening in time to protect yourself, or will you be one of the people who wakes up 5 years from now wondering how they became so much poorer while the numbers in their bank account stayed the same? That choice is yours to make, but the clock is ticking and the tide is going out. Friends, thank you for being here today.